guys, this is Professor Don Bush. I'm so glad you're here. You've come to the right place to learn accounting. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. So let's get started. Today's lesson is for folks that are probably in their second, third week of class in accounting, your very first accounting class. And what we're doing is we're studying the accrual and cash basis of accounting. And the accrual and cash basis of accounting, as mentioned in a previous video, are two ends of a spectrum. And on one side we've got the accrual basis, on the other side the cash basis, and they're just different ways of looking at how we record transactions. And they're both useful, they're both good, and the accrual basis is used for larger businesses that have to have their books audited. And the cash basis, a lot of small business people use the cash basis, and it's terrific for that. Also, taxes are also done on the cash basis. So let's get going. So this is the second example, folks. The second example, so here we are. So we got to answer a couple of questions here first so we know what we're doing. So when do we recognize revenue? Well, on the cash basis, it's really easy. When money comes in, when we receive money, when we get paid. That's the cash basis. Now, the reason why taxes are done on the cash basis is because the IRS believes, well, the best time for you to share money with them is when you receive money. So that's why taxes are, for the most part, done on a cash basis. So when we get paid, how about the accrual basis? Well, on the accrual basis, when we get paid doesn't matter. What matters is when we do our job, when we complete our job. So here we go. And when do we recognize expenses? Well, on the cash basis, when we pay for the expenses, when we pay for things. You see, when do we recognize revenue? When money comes in. When do we recognize expenses? When money goes out. That's the cash basis. Really easy, very cut and dry. There we are. On the accrual basis, it's a little different. It doesn't matter when we pay for the resources. It doesn't matter when we pay for the labor that we used or the materials that we consumed. But what matters is when we consume these resources. And we try to match that with when we earn the revenue. So there's a little bit of a matching principle there going on. So there we go. So folks, here's what's going on with Fred's snowblower service. Well, here we are in the pink box right here in the middle. There we are. All right. Well, here's what's going on. A customer orders a special snowblower. This is a real fancy snowblower, really nice. So, and the customer orders it in May. And the customer pays for the snowblower in June. All right, so this is money coming in June. So Fred orders the snowblower from the wholesaler. Well, in May, the customer comes in and wants a snowblower, and Fred orders it from a wholesaler. And Fred pays the wholesaler right up front for this. $3,000 right up front. So that's when the cash goes out. Now, Fred receives the snowblower in July, so it takes a couple of months for the snowblower to arrive, and Fred delivers the snowblower to the customer in July. So you have to ask yourself, if you want to figure out the accrual basis, is when did Fred do his job? When did Fred complete his job? Well, Fred completed his job in July, right? That's when it was all said and done. So let's figure out what the financial statements will be for the accrual basis. So here we go. So on the accrual basis, when do we recognize revenue? When you do your job. Well, Fred did his job. He completed his job in July. And so that revenue would be the $4,000 that was charged the customer. So there we go, $4,000. Expenses, now Fred paid for the expenses way back in May, but we don't really care when the expenses are paid for, but what we care about is when they're consumed. And that would be in this case, when Fred delivered the snowblower. All right, so the expenses would be $3,000 right there. And so the net income for July is $1,000. Now, folks, there's no numbers going in May or June at all. And you might say, well, why not? Well, he paid for the snowblower in May. Why isn't there $3,000 here? Well, it doesn't matter when it was paid for. What really matters is when it was consumed and when was the job complete. So here we go. In June, there's no numbers either. And you might say, well, gosh, he received $4,000 right here in June. Well, it doesn't matter when he gets the money. What matters is when does he complete his job. So coming down here to the cash basis, let's see what's going on here. Now on the cash basis, it doesn't matter when you do your job. It doesn't matter. All what matters is when do you get paid and when do you have to pay out money. That's all that matters. So in May, Fred has to pay out $3,000. So that would be an expense. That's the cost of that snowblower that he sold. All right. No revenues recognized. And so in May, his income statement looks kind of bad. He's got a net income of negative $3,000. But then in June, the customer pays for the snowblower. So Fred's going to have, let's see here. There we go. So in June here, Fred is going to have some revenue on the cash basis because the customer paid for the snowblower in June. So here we go, $4,000. Now, for this particular snowblower, there's no expenses because Fred didn't pay out any money in June. He paid it out back in May, but not in June. So we'll have nothing there, and Fred will have a net income of $4,000. Now in July, there was no cash happening in July. No cash coming in, no cash going out. So in July, nothing happening. So you can see that the difference here between the accrual basis and the cash basis can be really, really big. In this case, it is really big. Fred, on the accrual basis, Fred is claiming all his revenue and expenses in July, but on the cash basis, it depends on when he's getting paid and when he has to pay out money. So it looks very, very different. So anyways, folks, that is the difference between the accrual and cash basis. Now, one question that a lot of people ask is they say, hey, well, which way's better? You know, which way's right? Well, they're both right. It's just different ways of doing things. And which way's better? Well, for larger companies, I think it is better that they use the accrual basis because there's this matching of revenues and expenses. And on the cash basis, we don't have that so much. But if you're a small business and all you're worried about is paying your taxes and that kind of thing, the cash basis is pretty good. And by the way, we pay our bills with cash too, right? So the cash basis is not a bad way to do things. But it's not allowed under generally accepted accounting principles. All right, so there we go. So folks, that's the lesson for today. Hope you enjoyed it. Hit that subscribe button, hit that like button, and we'll catch you